Might be at critical mass, so would love to get this kicked off. Welcome to everybody who's joined us for today's conversation. Happy to have you here. Um, my name is Hannah Godalman. I'm a senior program manager at the Financial Health Network, and I'm very pleased to be moderating today's session. And we're really glad that you all could join us. Before we dive in, just a couple of quick housekeeping notes. We are going to be taking questions throughout the session from those of you who are in attendance. So please feel free to use the Q&A function anytime. We're going to do our best to address as many of those questions as we can during our discussion. And we might save a few for the end if time allows as well. Today's conversation is going to focus on short-term liquidity tools. These are solutions that help people manage recurring cash flow gaps. We know that many people in America face ongoing gaps between their income and expenses. Spending equal to or more than income can lead to challenges like stress and trouble building savings and incurring costly overdraft fees in order to cover those everyday expenses. We are here today in partnership with Chime. We're going to be drawing on insights from their experience developing SpotMe, which is a free alternative to traditional overdraft products. Today's conversation is built around some insights from Chime SpotMe product development journey, and we'll also explore how Chime thinks about impact and some of the lessons learned along the way in developing this free alternative. With me today, I have two wonderful speakers. I have David Silverman, who has been involved in consumer finance issues from a wide range of perspectives for over 3 decades. When the CFPB was established in 2011, David was named the Associate Director for the Division of Research, Markets, and Regulations. David retired from the CFPB in 2020 and now serves as a Senior Fellow at the Center for Responsible Lending, Senior Advisor to the Financial Health Network, and an adjunct professor at Georgetown's Public Policy School and Harvard Law School. Welcome, David. And we also have Roy Ellis. He is the Director of Economic Insights and Impact at Chime. Roy and his team focus on measuring members' financial health, understanding how macroeconomic conditions shape their financial outcomes, and assessing the impact of Chime's products on their financial progress. So I'm thrilled to have both your expertise and perspective today as we unpack today's topic. So without much further ado, let's dive in. I'd like to get started, to lay some groundwork and discuss some of the factors driving this demand for short-term liquidity solutions like SpotMe. So David, love to kick it off by talking a little bit about overdraft. So, despite years of reform, declining fee revenue, overdraft remains a $12 billion plus issue, according to our latest estimates. From your perspective, why has overdraft proven so persistent for banks and for customers?
Sure. Thanks, Hannah, and thanks for having me here. Yes, I think about that from both the supply side and the demand side. So if you think about it first, let's start with demand side. I don't have to tell the folks assembled here that there are a lot of people in the United States who are financially struggling in poor financial health, struggling to make ends meet, who don't have a savings cushion to fall back on, or if they do, it's something that they're trying to preserve and they don't want to tap into to meet day-to-day expenses. And so there is a need for liquidity, for credit, either because simply there's a mismatch in timing between when a payday occurs and when bills are due, or because there's volatility in income or expenses and there's essentially too many days at the end of the paycheck, if you will, at the end of the pay period, and money's run out, and so they need to so that's certainly one driver of overdraft is The other thing to keep in mind, and we'll talk about this a little more, I think, is that managing one's financial lives has been becoming much more complicated than it used to be. When I was a kid, I had a checking account, and the way I could spend money was to write checks, or I could go to the bank and take money out. And I had a check register, and I maintained a list of all the checks I made, had written, ran a running tally, and I knew how much money I had at all time. In today's world where people have debit card purchases multiple times a day and they have a pre-authorized debits, and there's ACH transactions, and they're sending money to and from through P2P apps that are connected, it's much harder to maintain track of finances. And that, I think, is another factor that drives demand, if you will. And then on the other side, on the supply side, look, overdraft is a very profitable business. If you think about it as a business line, it's a very profitable business line. It generates, as you said, $12 billion. There's not a lot of cost associated with that. Some cost for sure, but not a lot of cost. So it's profitable for the financial institutions offering it. Uh, checking accounts are valuable products for consumers. They're expensive products to deliver for banks, for financial institutions. Uh, and they tend to be given away for free. Uh, and there's no free lunch, so it has to be made up somehow. And over the business model, that's for better or worse, the business model developed is that overdraft became a source of revenue to make it possible to offer free or free checking.
Yeah, that's super helpful. I think to your point around the kind of demand side, we have research that shows that many overdrafts stem from small everyday purchases. They're often unintentional, so kind of due to mental accounting errors or misunderstanding timing of when transactions hit and money comes in versus out. Or many people, it's essentially a gamble. They think they might have those funds, but it's a 50-50. How do these insights inform the way we think about overdraft as a product and its costs for the consumer?
Well, I mean, I think what you say is 100% right. So I think we tend to talk about this is just a credit product, and everybody who's using it is because they're making a conscious demand, a conscious decision to uh to borrow money,
Mhm.
understanding the cost of doing that. And our research indicates that that's true of a segment of the population, but it's not true of everybody. And so we have to understand that for some people, this is just a very costly mistake. They thought they had the money in the account. They forgot about the pre-authorized debit that's going to come in, or they thought that they're checking they get paid on such and such a day, and it actually no, that's payday, but the money doesn't actually make it to their account for 2 days later. And so for some, it's just a very costly mistake. For some, it's a conscious decision to borrow. And those are very different use cases and different consequences. And as you say, in the middle, there's this group of folks who they know they're running short. They're keeping their fingers crossed, and they're hoping that the next deposit hits and they gets credit to their account before this transaction clears or before that debit appears. And it's a gamble, and it's how you think about that is this in between case. But again, with a large cost associated with gambling wrong.
Mhm. Yeah. Yep. So, given this, kind of given the costs of these gambles and the challenges in juggling these kind of everyday transactions, and given the current landscape, what opportunities do you see for financial institutions to be rethinking short-term liquidity in a more consumer-centric way? And I'm sure Roy's going to have a lot to say here, but want to give you a chance to weigh in first, David.
Well, I mean, I think first we should acknowledge the progress that has been made over the past few years.
Hmm.
Uh, it's stalled, but there was a burst of activity uh, in which we saw a lot of particularly larger financial institutions, but financial across the board, either going in one of two directions, I'd say. Some went in the direction of we'll try and deal with the mistake issue, if you will, and some of the gambling by we'll provide a 24-hour grace period, we'll increase the cushion before we charge an overdraft, but we'll keep our fees the same. So for those who, if you're using it as a credit product, you're going to pay what you've been paying. We'll try and reduce the gambling and the mistakes. Query whether that actually reduces gambling or increases gambling, whether people are more likely to gamble if they know they have 24 hours or they know they have $50 cushion, or whether that makes them more cautious. I don't know the answer to that, but we do know that it's significant. There's been a significant reduction in overdraft revenue. The other track that some banks was to significantly reduce their costs, or certainly, I certainly can't watch football these days without seeing the Capital One man talking about how they eliminated overdraft costs, and that was a second choice. Uh, and then I guess I mean, we could talk later about the question of what kind of alternatives to create to outside of the checking account contacts for small installment loans, if you will, as an alternative way of meeting the credit needs. We tend to
Mhm.
talk about the need for short-term credit. I'm not sure a lot of people have a need for short-term credit. They have a need for small amounts of credit, uh, which whether they were better off paying it out, having to pay it back at the next paycheck or in 2 weeks, rather than paying it back in installments over a somewhat bigger period of time. That's an interesting question to discuss as well.
Mhm. Mhm. Agree. I'm glancing to see if we have any questions quite yet before I. It looks like there's comment. Is it really a gamble if banks control posting dates and times?
So well, certainly it is. It's a gamble from the consumer's perspective. The
Hmm.
consumers don't know when that, they're right. They're making a transaction, making, let's say, a debit card purchase and unsure what the state's going to be. And I think, quite frankly, banks don't control for if it's a check that somebody's written, they don't control when that check is going to be presented uh for payment. They do control when and then the ACH network determines how quickly that moves and when funds get credit. For deposits, the banks, do have some control as to when they give credit once they get a notice of an ACH deposit coming in for sure. And for pre-authorized debits, it's really up to the banks. Once the debit comes in, it gets paid pretty quickly. So it's not really entirely the bank's control there.
Hmm. Yeah,
But I mean, there certainly is a piece. I don't want to minimize the piece around funds availability, and when you make funds available, that is something that banks can control and can look at.
yeah,
There's been
yeah.
some as well.
That makes sense. Yeah, there's two sides to it. It can be difficult on the consumer end to manage that mental accounting task. Um, well, thank you, David. I think that helps us set the stage a bit for thinking about how those trade-offs play out in practice and how we might innovate to um, alleviate those challenges. Of course, one innovation that often comes up in this space is Spot Me, as I mentioned. So I think we can use that as a starting point for the next part of our discussion. Roy, would love to hear a little bit from you to get us started. Chime has really positioned itself as serving everyday consumers and challenging these sorts of punitive fee structures. How do you think about Chime's mission and how did that shape the creation of Spot Me?
Great. So first again, thanks so much for having me. And it's a good question. So Chime's mission's actually evolved since I've been here. I joined Chime about 5 years ago, and Spot Me was introduced in 2019. And at that time, Chime's mission was to help our members achieve financial peace of mind, right? And to me, sort of, there's a pretty direct line there. So let's just revisit again for the state of overdraft in 2019, and we can kind of teleport ourselves back to then. Um, David, I think you can please correct me if I'm wrong, but I think 2019 was the high point of overdraft before I think in 2020 overdraft kind of was reduced because of the pandemic. But 2019 was the high point, and so there's a great report from the CFPB that estimates $15.5 billion of overdraft into and NSF fees in 2019. So I think about the stress of having to pay those fees and the stress and potential embarrassment of a payment not going through and the frustration of knowing that the payment would have gone through if the timing had been a little bit different, and then like you've mentioned this a couple of times, but the cognitive load of always thinking about all the timing and all the, like when is it coming, like when is my paycheck coming in and when is the next, scheduled bill going to be paid and all that. And so managing all those details is something that's incredibly difficult. And so the line again from achieving financial peace of mind to Spot Me, it was like pretty direct. And so Spot Me basically helped avoid those fees, gave you the comfort that the payments, up to like your Spot Me limit would go through. You wouldn't have to constantly check your balance. So you just have like a little more of that wiggle room. I should say, by the way, that it's a similar logic that led Chime to develop what we call early paycheck, which is just a feature that as soon as your direct deposit comes through, we process it, right? So you can kind of get paid 2 days early, right? But it's not really 2 days early. It's when it should go through. Everyone else is kind of holding on to that money for a little longer than they need to. So that's to me the connection between the mission, which again has evolved since then, but the mission of helping people achieve financial peace of mind and Spot Me.
And that actually it makes me think maybe could you provide a very quick summary of how Spot Me works for those who might be less familiar in the audience?
Yeah, it's great. Sure. So Spot Me is basically a fee-free overdraft feature. It allows eligible Chime members to spend up to $200 beyond their account balance on card purchases and cash withdrawals, so using your debit or secured credit card or withdrawing money from an ATM, and without being charged any fees. And then what happens is the negative balance is automatically repaid from the next deposit. Okay, and then that replenishes your Spot Me limit. And the eligibility is basically just if you have a qualifying direct deposit of at least $200 a month, and then once your eligible members decide whether they want to enroll in Spot Me or not, they can unenroll at any time, or basically set their limit at 0, or they can set their own personal limit at the max that we offer, or somewhere between 0 and the max. So they have a lot of flexibility in sort of how they use it.
Thank you.
Right.
Yeah, and Chime has often described, this obsessive focus on understanding member needs. You call your customers members. You spoke a little bit to the consumer pain points that Spot Me and early wage in some ways is addressing these kind of gaps between income and expenses and the cognitive load and the stress that comes with that. Are there other consumer insights or behaviors that kind of shaped the design of Spot Me?
Yeah, sure. It's a great question. And first, I'd also say that kind of member obsession extends beyond understanding the pain points. Mm. There's just a culture of really valuing our members and celebrating them. So when right now I'm in our San Francisco office, if you walk up to the 6th floor, and the 6th floor is like where all the fancy C-suite people sit, the first thing you see is actually sort of like a wall of member portraits, right? And when we often have members come into the Chime office, and we have events organized around that. They kind of tell us about their experiences and their needs, right? And so actually, the last event I went to, it was pretty interesting, was a number of members who had recently chosen another financial institution, and we just want to understand, well, what were you not getting from Chime, right? So there's this real sort of celebration of our members and wanting to understand them and and valuing them, and I think that kind of drives that member obsession, and so that's just sort of the stance, and it's a part of the culture of the company. In terms of other insights, sure. So when Spot Me was first introduced, right, the way that it kind of happened was it was basically piloted with 30 direct deposit members, and they each basically had a $20 limit. Right. And so initially it was insights, very qualitative insights from talking to these members and understanding sort of how much do you actually how much would be useful. And so, when SpotMe launched, limits were actually up to $100. And then at some point we got pretty direct feedback. So that's another insight, like another source of insights that members wanted more. So we found a way to double the limits up to $200. And then you also get feedback, not sort of from researchers, but from customer service, because people call and say things like, hey, my SpotMe limit changed and I don't understand why. And then we realize that there's things that we can sort of improve in the way that we set the limits and how they change when your paycheck changes to make it more understandable to members. And so over time, there's just more and more refinement that you can have. And and the insights come, again, from customer service calls, from interviews, from surveys. And they also come just from transactional data. So this might seem obvious, but some people are on a weekly pay cycle, some are on biweekly, some are on semi-monthly, and so on. And their liquidity needs might be a little different, right? SpotMe comes into effect basically at the end of the pay cycle, right? And so understanding how that, how many people are in each of those pay cycles and how that impacts your need for liquidity, that's another source of understanding that it's possible that the kind of qualitative interviews or the surveys may not have, surface that insight, but looking at the transactional data, you see that pretty clearly.
Mm-hmm. Yeah, that's great. Um, I I think I think especially the kind of raising the limits from doubling the limits was a really great example of how kind of that feedback loop played out. That folks wanted more and kind of developed a way to do that in a uniform way. I think you know Chime has also mentioned that something like this, something like SpotMe, really didn't exist at scale at the time. So would love to hear a little bit about how you managed risk while expanding access in this way.
Yeah,
How does that work?
yeah. It's a great question, and I love the way that you kind of describe that kind of potential tension because obviously, the more broadly you provide access, the more you're taking on potential risk. And so, it would obviously be nice if you could provide access to infinite resources to everyone, right? But there's obviously a level of risk that no one can really handle. So I'd actually say the simple way to understand this is if you Google right now, how is my SpotMe limit decided, and you got on our webpage, that would be like the top result on Google, right? So go to our webpage, and what you'll see is this, and I'm just going to read verbatim. It says, how is my SpotMe limit decided, right? And you tell our members, Chime SpotMe limits are based on several factors, including how long you direct deposit. The longer you deposit, the better. How much you direct deposit, right? Keep the amount consistent or bump it up if you can. And 3 is how much you use Chime. And so that's just sort of in very sort of intuitive terms, that's basically sort of what's behind it. But it's a simple idea that researchers, including the Federal Reserve, have written about for a long time, thinking about credit, although sort of historically that research was focused in response to the shortcomings of using people's credit histories, right, and traditional credit scores for underwriting. And so, if you're familiar with literature, you might be familiar with the terms, alternative data and financial services or cash flow underwriting, but that's basically it, right? So you don't need to have a credit score to know that someone is good for it. We have wonderful sort of primary, account relationships with our direct depositors. We know when their money comes in. We know they're good for it, right? And so the basic idea is sort of the more that account is primary, and the more information we have, the more that we can provide while keeping the risk at an acceptable level.
Yeah. And I think, we'll get into a little bit more about the broader business model in a little bit. And I do see a number of questions coming in from the audience that I'll get to shortly. But before we do that, I want to talk a little bit about, how you define success for a product like this. We talked about kind of the things that informed its design, the way you think about balancing risk. But how are you tracking success and outcomes at the consumer level?
Yeah, it's a great question. So I'd sort of take a step back and say that sort of in general, we track 2 types of success. One is success, on business, for the business, and one is success in terms of the mission, which again, I described earlier that the mission when SpotMe was first introduced was about helping our members achieve financial peace of mind, and today it's about helping them achieve financial progress, right? Which is sort of like a much sort of like longer term vision. So, but we track success against both of those, right? And so, sure. So, like on the business side, we track things like how much do people use SpotMe? How engaged are they, right? How much more likely are they to retain at Chime? And so those are sort of like some of like the business metrics, right? But then in terms of understanding, is it actually helping people? Is it doing the job that we want it to do or that our members want it to do? Then we look at sort of the impact on their financial health. And so I'm happy to kind of talk more about that. But there's actually quite a bit that we do on that side. And let me know. I don't want to go on forever about it, but I'm really happy to dive into it if that's interesting.
Yeah, I certainly agree. We could keep this conversation going. I think one thing maybe we can touch on before I turn to a couple questions from the audience is, in thinking about tracking success, um, I think how to balance tracking that success with product success over time. And I think one thing that comes to my mind is SpotMe Boost. I don't know if you want to talk a little bit about that, and how that idea came about.
Sure. Yeah. So SpotMe Boost is basically the idea that you can basically, so let's say your SpotMe limit is $50, and so that means that you can overdraft up to $50 fee free. The idea of a boost is that every month you can boost other members up to $5, and you can get, I think, up to 4 boosts. So that's an additional $20. And then you can also get boosted back. And so it's basically sort of like a social side to the, it's a way that the Chime community like can support one another, right? So for us, it's both a way that we can extend the SpotMe limit, so increase the limit, and also help spread SpotMe to more members, right?
Mm-hmm. Yeah, I've looked at some of the Reddit threads, and there's a lot of engagement and chatter around the use of boosts and boost buddies. So there certainly
Yeah.
does seem to be an element of engagement there.
Yeah,
Let me,
it's super interesting how engaged people are about, yeah, for sure.
yeah, absolutely. Well, let me look at a couple of these questions before we move on here. So let's see. We have one question is SpotMe, is this more centered toward people with poor credit records? I notice on the webpage it's talking about building credit. Can you speak to that?
Yeah. Interestingly, not really. It's really more about that response to traditional overdraft, right? So it's, we don't, we don't report any, SpotMe usage to credit bureaus. We really don't think about it in that way at all. It's really just the idea of extending that extra sort of like that leeway at the end of the pay cycle if it's needed, alleviating some of the stress and reducing the fees, reducing the need to balance and think about the timing of all those things. It's really not about helping build credit. We have other products that help establish credit and build credit, but SpotMe is not really that.
Mm-hmm. I think one or two more clarifying questions.
Sure.
Is SpotMe the same as MyPay instant advance fees? And MyPay is a different product, but maybe just touch on that briefly.
Sure. Yeah. So no, so these are two different products. SpotMe is the fee-free overdraft. MyPay is earned wage access, and so that is a different product, and that's just basically sort of like as you go through the pay cycle, and you've already worked 7 days out of like the 14 in your 2-week pay cycle, or say like 5 out of 10. Hopefully you're not working all those weekends. Then you are able to access the like a portion of your paycheck. That's MyPay, and then the instant fee is a fee that is charged if you want to access that advance instantly, and if not, you can get it for free within 24 hours. But those are two different products. Thanks for the question.
Yeah, of course. Um, and then I think the last clarifying question was, does Chime provide financial education with Spot Me service? You talked a little bit about the kind of the terms you lay out on the website around what factors into limits. But the question says a lot of our clients use this service and can become addicted to it, get stuck in a cycle of using it. What services do you offer as far as financial education?
Yeah, okay. It's a great question, and I should love to sort of address like both parts of it.
Yeah.
Or so okay, so one is yes. So there's a lot of financial education, it's sort of like general financial education. It's like on the website, like on the blogs, things like that. One of the things that we're doing now though is integrating financial education a lot more. Sort of like in a more sort of centralized core way into the app itself, and so that it's available to folks, and the idea is that most people will look to sometimes you're just interested and you want to educate yourself, but a lot of times you kind of need to learn about how something works, and about alternatives and things like that in the moment. So it's sort of like this like idea of just in time, and so we are actually right now working on building that out, which is something that's really great. And hopefully having that kind of like that just in time, very kind of specific resource is even more effective than just kind of having like the general education on the site.
Mhm.
I think the second thing is it's interesting. I'd be curious to understand more sort of about the background of sort of the comment about being addicted to, because you could think of sort of obviously like very frequent use is something that could be an indicator. That could also just be an indicator that it's really useful, right? So once right, once you know that you have that, I mean, David, you kind of made this comment earlier, right? Like once you know you have that cushion, you're more likely to use it, right? This is sort of like one of the counterintuitive findings that people found. So economists at the University of Chicago many years ago found out that when cars started having seatbelts, people start driving a little faster, right? And that's just sort of that's a very natural human thing to do. So if you know that overdrafting is going to result in a $35 fee, right, and your payment's not going to go through, like that's a problem. If you know that you can go all the way to your limit and you still have a little extra, you're going to change your behavior. And so it's just like, it's an interesting question. I think that we would not see that as a sort of a negative consequence. It's actually just sort of like a new norm it's a new behavior that is sort of lets you not worry about, again, like all those kind of stressors that I mentioned before, and at no cost. And so anyway, I think it's an interesting discussion, but I think it's important to kind of distinguish between different behaviors that might look the same on the surface and kind of interpreting what's happening behind the scenes.
Can I jump in on that, Hannah? I mean, I think
Yeah.
Yeah, please do.
there's a third possibility, Roy, is that because you have, as you said, you use overdraft spot me, your next paycheck is reduced to repay your negative balance. You
Mhm.
now have less money in the next pay cycle, and that may fuel the need to use it again because your whatever paycheck is now $50 less than it would have been. I think that's much more. I mean, that is much more of a concern with a fee product, where each time you do it, you're incurring another fee.
That's right. Yeah.
I mean, to the extent you're generating that behavior, you're maybe creating demand, but you're not charging for the demand. So that feels quite different to me than products where you're generating demand and there's a cost associated with it.
Yeah, so I agree with that. I think that sounds right. And but I think in general, sort of, we think about kind of like being able to smooth your consumption as a good thing, right? So if you have, you know, if you're able to order, five pizzas, on, like the day after your paycheck, that's great. But by the fifth slice of pizza, you're not really enjoying that fifth slice. It's better to have a slice of pizza every single day, sort of like throughout your pay cycle. And so, yeah, I guess that's right. But in some sense, you're borrowing from yourself, that $50 from the next pay cycle in order to smooth, in order to have a slice of pizza every single day, or whatever it is, right? To fill gas in your car every single day this month or this pay cycle, as opposed to having, a lot in the beginning and like nothing at the end. And so, but I agree with you, right? If there's no other cost associated with that, that seems like a net win. If there's this cost associated with that, maybe it's a different story. I don't know if that sounds right to you.
Yeah, no, I think it is very different. I mean, that's the
Yeah, yeah,
payday loans have the same phenomenon
sure.
of, but each time you take out a new loan, you're now paying another $50 or whatever.
That's right. Yeah.
Mhm. Well, I think I'm gonna bookmark some of these additional audience questions for the end here. But wanna take a chance to kind of move the conversation on Spot Me, on how we might be able to translate some of the learnings into takeaways for the rest of the industry. So, you know, we've already talked a little bit about the trend we've seen in overdraft reform at several large banks. Some industry observers have suggested that fintech innovations like SpotMe have actually helped catalyze some of that change through competitive pressure. So, Roy, I'd love to hear you talk a little bit about, whether you see SpotMe as a disruptor or a proof point about what's possible in the system. And then, David, maybe you can chime in on um, how we kind of see if there's challenges or barriers to how traditional institutions might adopt kind of similar safety nets.
I mean, look, we definitely see it as a proof point. It's really hard to establish that innovators like Chime help push the entire industry. This happened. Again, 2019 is the year before COVID pandemic. Like there's a lot of
Yeah.
stuff that changed, right? But it's hard to imagine to me, right, that we didn't play some role. I really do think sort of like the proof point that it can work and that you can, that it's popular and you can manage the risk. I think, to me, I think it was at least a sort of a powerful motivator. Um, Again, hard to kind of prove that out if that's sort of the question, but we think it was um, an important proof point to put out there.
Yeah. And how possible do we think, it is within the system? And maybe David, this is where you can chime in.
Well, I mean, if there's, it's harder to give up money that you're making than to start
Right.
de novo and not make the money. I think part of COVID helped. I tend to think that because overdraft revenue declined during COVID because of the less usage of overdraft, made it easier to have reforms put in because you were not foregoing revenue, you were just keeping things flat, foregoing opportunity costs rather. Uh, so you have that. It's also the case that traditional banks have, you can call it legacy cost, you can call it, they have branches, they're delivering additional products and services beyond what Chime's offering by intent. And so there's cost associated with that have to be recovered. And that's an obstacle. And look, I think we would be remiss if we didn't acknowledge that there is such a thing called the Durbin Amendment, and that Chime has the benefit of not being, it has it acknowledged a model that's built largely on interchange as a source of at least the checking accounts. And because Chime falls under the $10 billion threshold, it's not subject to the same interchange limits, and that is a limiting factor. Now, it's certainly the case that before there was a Durbin Amendment, there weren't a lot of banks doing what Chime's doing. I don't want to suggest that somehow uh, there's quite cause and effect, but that is a limit. That is a limiting factor in terms of if you're trying to run a business and call it your interchange revenue is 50% of what on a transaction basis of what a non-regulated entity can get, that's going to affect the economics as well. And those are all factors. But is there opportunity? Sure. I think with all that said, is there opportunity to do more? I always live by the notion of whatever is possible, and we've seen even mainstream banks doing. Uh, there's leading edge, and there's people who are lagging.
I mean, and David, you did mention Capital One, right? So there, as an example, like so they dropped their overdraft fees, even though they're a much larger institution. I think a part of it is this, again, this might sound naive, but I actually really I want to go back to that member obsession point. I think some of it is also culture. It's like very, very hard to change the culture of a large institution. You know, Chime is built like many tech companies, right? Where when I just kind of describe that the way that SpotMe was developed, that's the way that sort of product managers think about, like what is the job that we need to do? How do we do it best? How do we quickly iterate? It's a very different, again, it's starting with, interviews and surveys and, really trying to kind of understand like what problem is this person having or is this group of people having and experiencing and how can we solve it? That's like a very different culture than when you're like a very large established business and you're trying to think about how to sort of like, squeeze an extra 0.5% of efficiency out of some whatever it is, right? So I used to work at like very large companies also. It's like a different culture. And so does it mean you can't have that culture like if you're a large bank? No, it doesn't mean that. But it's kind of hard to change it. It takes time.
But I think there are some lessons to be had from what could you draw from that culture of um, kind of creating those feedback loops, kind of figuring out ways to merge engagement with success outcomes. I think there's certainly some applications um,
Absolutely.
in the design of SpotMe. Um, I think I'd love to talk a little bit more about how financial institutions and how Chime specifically thinks about measuring how their products impact financial health. And I think that's also a question we got from the audience. So, what metrics are you using, both, in the way that SpotMe might contribute, but even zoomed out further than that?
Okay. My answer is going to sound like I designed it just because you're the person who asked me the question, but it's not. So um, when uh, when we basically transition or sort of like evolved our mission to make it broader than just helping our members achieve financial peace of mind, but thinking much more about how they make financial progress, that just brought us directly to the question of, well, what does it mean to make financial progress? Well, it means to us that you're improving your financial health. Okay, well, how do you measure financial health? And, we very quickly came to, decide we're not going to define that on our own, right? That's just it's not fair, it doesn't make sense, but also there's been like amazing, wonderful research done, and so we built on all the really tremendous work that you've done. And so the first thing is that we adopted the FHN framework and think about spend, save, borrow, and plan, and we regularly field the 8-item survey to our members, and so that's a starting point. And so now I think I just mentioned two different things. I made it sound like one, but it's actually two. So one is the framework and the kind of conceptually what you are aiming for, and two is like how do you measure, right? And so we adopted the framework and we started sending out the surveys, and then we kind of went from there. And so we realized that the surveys were incredibly useful, but there were also challenges in trying to kind of correlate usage of a specific product with kind of changes in someone's sort of financial health status. And so then we evolved the kinds of survey questions that we ask. So we still ask the financial health, the 8-item survey, but now we actually like developed another sort of battery of questions they map still to spend, save, borrow, and plan, but we just ask the questions a little bit differently. And we ask basically, how much has Chime helped you in this particular way, right? And there's a lot of iteration kind of survey research that went behind that. And it just turned out that it kind of helped get us like a much cleaner measure. And now we're much, better able to kind of correlate that with, with usage of, let's say, SpotMe or MyPay or like automatic savings products or whatever, right? And then we also lay on top of that all the transactional data, right? So you can kind of look at sort of like all the traditional sort of, like what is your balance or like what's your minimum balance, right? How many days of savings do you have or weeks or months or savings do you have? So you can measure that, right? You don't have to ask people, you can actually just measure it in the transactional data. And then we've also kind of come up with our own internal metrics. We have one that we call stress days, and it's sort of just a measure of like how long at the end of your pay cycle are you kind of like holding off on making any additional purchases, right? Because you're kind of waiting for that next paycheck to come in. And so basically sort of it's just been an evolution, but sort of like the keys, honestly, were to start off with a framework, right? The framework is, grounded in economics and research and sort of uh, then and then kind of just going from there. So like iterating the surveys, adding the transactional data, coming up with our own metrics. And I'll say like one last thing is like, ideally if for anyone with sort of like a research background, on the call, the gold standard is that you're always, is to run like a randomized control trial, right? So like it's like an A/B test. And there are times when you can do that, but there are also times when you can't do that. And so I think like the last piece of it is just to invest a lot of, some say a lot, invest resources in kind of figuring out how to get past correlation towards causation. And there are ways you can do that, and you can work with product teams to do that, in the ways that you release products and the timing of the release and things like that that get you almost as good as an A/B test when it's not possible. So, but you really need to have that kind of culture to set it up ahead of time. It's a lot harder to do it after the fact if you didn't set yourself up for success in that way.
Mhm. Yeah, I mean, on that topic, are there, in this process of developing these frameworks and measurement tools, is there anything that's come up that's been particularly surprising or insightful that comes to mind?
That's a good question. Anything that's been surprising? I mean, I wouldn't say in terms of like any of the metrics themselves it's been surprising. Again, there have been like some pleasant surprises that in our ability to use surveys to pick up what we were wanting to pick up. Again, surveys are wonderful in lots of ways, but they're subjective. They can be noisy. They can be very tricky to use well. So I've been pleasantly surprised at how useful we've been able to make make the survey questions like, once we've iterated on them. But
Mhm.
I'll just say sort of like more generally, we are constantly surprised by how complicated, you know, consumer finance is, by how uh, smart and interesting, but also again, sort of uh, surprising, like people can be in the way that sort of that they move their money around in the way that they want to sort of like protect this bucket of money and not touch it, but sort of, use like something else for it. Sort of people are very, very complicated and and that's always surprising. And sort of like the way that you can build on that is from when you going from just like the surprise to figuring out like what are the systematic patterns, right, in which people are surprising and kind of use those to kind of help improve the product. So always sort of surprised and delighted at learning more about how humans work.
Yeah, I think that's exactly right. David, were you gonna say something?
Double down just on a couple of, I think, really important points Roy made. I mean, one is the value of combining survey data with transactional data.
Yeah.
The second is trying to figure out what are the things that a financial institution can impact and measuring those within a particular product relationship. So, I mean,
Mhm.
ultimately, if you want to improve people's financial health, you need to help them be able to save more, which means reducing spending some. So measuring to what extent are your customers saving more? To what, how many? I love this idea of, I forget what you call it, desperate days or days where people
The stress days, yes, yeah,
stress days. You're
yeah.
measuring the things that are you can influence in some way and seeing how that's being influenced. And I guess the third thing, just to double down on, is uh, there's always while I love randomized control trials, in the context of a financial institution and its customers, there's always going to be a selection bias. The people who choose Chime may be different than, but if Chime's able to help those people, even if it wouldn't help the real world at whole, the people who don't have that predisposition, that's wonderful. You don't have to, and so in that sense, being able to see what impact you're having, even if it's a correlation, without being able to factor out the selection bias thing. I think that I wouldn't worry about that so much.
Mhm. Yeah, that's really great. Um, well, in our last few minutes, I can't believe we're almost at the hour, but I want to take a couple more questions from the audience before we wrap up. given how many we've seen come through here. Um, I think that this keeps us on the topic of, measuring outcomes and using data. We have a question that uh, it is really hard to retrain consumers with bad money management skills, especially given the illogical, irrational behavior of consumers. Chime has been very successful getting the attention of consumers who need help. I'd love to hear more from Chime on how it plans to assist these consumers continue their financial journey to good financial health.
This is such a great question. And again, I think this sort of goes to the heart of what David was just talking about, which is thinking about like what are the things that we can control, right? What are the things that we can help people with? And so I'd say just a couple of things. One is thinking about the financial health framework, right? Of like spend, save, borrow, plan. One of the dimensions there is basically short term versus long term. And so the approach that we're taking is that we're first helping people with their sort of very short term, day to day kind of money management, right? And then you kind of extend that out to the longer term, and so part of that is in like the kinds of products that you offer. So, for example, we have automatic savings products, and so one of them is when your paycheck comes in, your direct deposit comes in, you can set aside a certain percentage of it to go straight to savings, right? And so you can do that even while you are helping with day-to-day management through things like SpotMe, right? And so, okay, is that going to help you save, for like 30 years down the road for retirement? Maybe, but maybe, but more obviously, it's going to help you have be able to save for specific goal, shorter and medium term goals. And so then we evolved that, and now we have these things that we call savings goals, which, to anyone on the call who's sort of a behavioral economics fan, this is more like enveloping, right? So the idea that you have an envelope and you put some cash in it for the rainy day, and some cash for your vacation, and some cash for, like going out Saturday night. And so these are tools that help people plan for like beyond just the day to day, but sort of like there's this slightly longer term, right? And same on the liquidity side, right? So MyPay as an earned wage access product is more proactive than SpotMe. SpotMe is something that is there to help you when you reach the end of the pay cycle, right? MyPay, like you are able to proactively, take an advance on your pay, whether you need it in that moment or not, or whatever. But it's just, now you're talking about slightly longer term planning. David mentioned, small dollar loans. That would be another way to kind of think a little bit more, and then you're kind of paying those back over, multiple weeks. So it is just kind of starting with that short term and then kind of building up to the longer term. And I just want to say like one last thing on that, which is there is this myth that everyone who's really great at money management kind of does it on their own. And, and I do know people like that, that really are just unbelievably skilled and disciplined. And I get that. Many, 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 many of us, benefit from entire sort of like infrastructures and kind of like systems like that help us. So if you think about like your 401k, right? And you think about that there's a huge revolution in sort of people's savings for retirement that came with 401ks where, initially, 20, 30, 40% of folks who had them available use them, right? And put money into them. And then, again, this is sort of like a behavioral economics a really important insight. When you change the default to sort of, well, you're in, right? And you have to opt out if you don't want to do it, right? That basically skyrocketed the participation rate to like 90-something%, right? And today the norm is just that's what you do. Like today, everyone who has a 401k available and can, does it, right? And so bringing that back to Chime, we also have sort of like a newer part of the business, which is Chime Workplace, and that is working with employers. And so, I just think it's not true that it's just sort of like up to individuals. And so part of what we want to do is like, again, like your 401k obviously works through your employer. There's also, there's a huge tax code that kind of incentivizes it, whatever. So we're also making efforts to work with employers and think about how we can provide that broader infrastructure that helps support like medium and long-term goals.
Yeah, thank you. In our last couple of minutes, David, is there anything else you'd like to address or bring up before we close it out? I don't think we'll have time for any other audience questions, unfortunately.
Not really. I think we've been great conversation. I've learned a lot even, so well, not even, but I've learned a lot. So no, nothing to add.
Great. Well, thank you both. I think we can start wrapping things up. Roy, David, I just want to thank you both again for such a productive discussion on kind of both the strategic and practical realities of designing short-term liquidity tools. I also want to thank everyone in the audience for your engagement. I'm sorry, we have more questions than we were able to get to. It's clear there's a lot of interest in how institutions can be rethinking overdraft and short-term liquidity in consumer-centered ways. So, stay tuned for more. There will be a recording of today's webinar available on our website. So know that that will be available to you. We will also be continuing this work with Chime, and we'll be publishing a case study sometime soon that dives deeper into this SpotMe product journey and member insights. So keep an eye out for that as well. And then lastly, I hope that you will all join us at this year's Emerge conference event in Atlanta, which is happening the week of May 19th. Registration is already open, so take a look at the agenda and consider joining us. There are lots of great content and speakers already lined up. And I think with that, thank you again for joining us today. I hope this conversation sparks ideas that you can take back to your work. David, Roy, thank you again for your participation.
Thank you, Hannah. Thanks, David. I learned a lot too.